All right, grab your favorite mug. It's time for Coffee with Your Retirement Coach. Welcome back to Coffee with Your Retirement Coach. I'm Aaron, and behind the clipboards today, we've got Nick and Randy Yeomans.
How you doing, Aaron?
Our secret is getting out. We have a previously our location has been tight-lipped and
undisclosed.
Never looked this good.
Never looked this good, for sure.
Didn't have to.
Yeah. No, this is exciting for our audience. We've decided to move more towards video. So if you're listening on your favorite podcast channel and you're wanting to kind of see what's going on behind the clipboard, you can now check out our YouTube channel. So we're really excited now to go both video and continue with audio, but this is a great new venture.
I'm just wondering if there's anybody that's not a student or a client that only knows us from the podcast that thinks, hey, these guys have faces for podcasts. So what have we?
We like the podcast.
Yeah.
I'm saying right now.
There was some hiding there.
Well, no, you can definitely see.
Now we know why they didn't do the video.
That's right.
part.
That's right. That's right. Well, if you were with us before, specifically for episode 9, you heard us talk about inherited IRAs. We talked about new rules on old money. The reality is the tax laws change. We joke often in the office that they're written in pencil.
Right.
And so today we want to break apart, what if I find myself on the receiving end of an inherited IRA?
Yeah, today's going to be a really good conversation because we are going to dive into, you've already made the decision or the decision's been made for you. So what's next? Now that you have found yourself to be the beneficiary of an inherited IRA, the money is going to come out. I mean, it's set up, it's done. What are your options?
Nick, when we talk about this, we always say, first of all, we don't want to pay taxes if we don't have to. But we certainly don't want to pay taxes twice. So A lot of our conversation really should be around how do I get the money out of the IRA? And if I've got to pay tax on it, there's no planning done ahead of time, what do I do now so that I don't pay taxes again?
That is the first thing people start wondering. Like, if they didn't even know they were going to inherit it, or if they are inheriting something and now they're aware of the number and they might not have been before, what do I get to keep of this?
Yeah, and so the thing is, there's a lot of options, and most of the time, you don't know what your options are, right? Like if you don't know, you don't know. So today we hope that you're going to be able to glean some different ideas. If you are on the receiving end of one of these IRAs or 401ks, 403bs, etc., here are some options that you could take advantage of that could certainly be beneficial. And Randy, I know you and I spent a good amount of time outlining some different options, and this isn't even a catch-all. I mean, we could do several episodes just going through all of the options, but today we hope at least to give you enough meat, enough information that you can start triaging it and hopefully arming you with some really good questions that you can go ask the professionals in your life.
Right. One of the things that people don't recognize about an IRA versus a lot of other assets, IRA, 401k, 403b, all of these deferred retirement account type of plans, is they don't get a step up in basis, which means unlike real estate, a brokerage account, or stock, when you pass away, those get a step up in basis and you're starting at the date of death with a new value from a cost standpoint for taxation purposes. With an IRA, we always talk, there's a mortgage attached to them, and that mortgage is the amount of money we're going to owe the government. So how do we, if we have to take the money out, if there's been no plan in place, now we've got the distribution, what we began to think about are what are the best things that we've been able to help our clients do. And one of them that I've discovered is a lot of times people don't realize that they could take proceeds from an inherited IRA if they have wages and are eligible, and they could fund their own Roth IRA.
Well, and Randy, let's just take one step back because really what I hope that we're able to give our audience today is, these are some practical things that you can do. This isn't like hypothesis. This isn't us just brainstorming. This is literal advice that we give people today. And so talking about the Roth and talking about how, I love my Uncle Sam, but I don't want him to be my biggest beneficiary, right?
Yeah.
Right? I love, great family. I'll pay my fair share, whatever that is, but I don't want to pay 1 penny more. And one of the most powerful structures that we could consider today is that Roth IRA. So Randy, why don't you walk through what the idea behind this is? Because I mean, really, it's refocusing or repurposing how you see the distributions coming to do what you're talking about.
Right. So what we found is that there are a lot of people who are eligible to make contributions to a Roth IRA, but they don't have the current cash flow. Well, now they've got a distribution coming from an inherited IRA. Of course, it could be small, it could be large. They could get less than what could fund the Roth, or it could be more. And there's so many different branches of this. Like, some people don't realize that they can fund, a Roth IRA for a non-working spouse if they've got wages. So a spousal Roth IRA. But even better than that, so there's some limits there. Like, I think it's $7,000 this year for the Roth contribution. If you're 50 or under 50 and older, you get another $1,000 makeup. So, husband and wife could put, I believe, $18,000 this year if they're over 50. So
16,000.
16, I'm sorry.
Yeah, I know you're good at math. So, yeah, 16,000.
I'm not used to the camera.
Yeah.
No, but, so there's that part. And a lot of times I think people believe that they have to do it out of their wages. Like, they couldn't do it with other found money, which is, I don't know why that is.
But really that key is you have to have wages to do what you're talking about doing.
And you have to be eligible. As a matter of fact, some people make too much money to have a Roth IRA, a contributory Roth IRA.
Yeah.
And, thinking about this, like, we walked through the matrix, one of the best ideas that we've done with clients. I think there's a clever alternative version of this too that a lot of times people don't think about. And that is, they might be able to fund more of their own 401k. And so if you're really trying to maximize the amount of money that you have, make it work for you more. If you have a 401k, and most 401ks today have Roth options, and you are not funding that up to the company match especially, that's free money that you're missing. So what we've suggested some people do is take that inherited funds, use that to make up some of their living expenses, and then reduce their salary at work. So they've actually got more money going into their 401k, certainly up to the match and hopefully well beyond that. Then they could make the election, regardless of what their income is, to put some of that money or all of that money into a Roth. The company match will be before tax, but the Roth after tax will grow tax-free and come out tax-free down the road.
Yeah, and while there are a lot of nuances and different rules with 401ks and specifically Roth 401ks, there are tremendous amounts of value there. So think about this. You now have a tax-free asset forever that also has asset protection. This isn't going to the Cayman Islands and spending $100,000 to set up a trust. This is your at-work 401k. Asset protection. And, people are stupid today. They will sue you over spilled coffee that was too hot, right? I mean, litigation is a real thing. So to be able to tax defer, have tax-free assets that are asset protected, and anyone in middle America that has access to a Roth 401k, you have to take a look at it. You have to get with your professionals. This isn't advice, but we're saying seek wise counsel. Okay, because this could be a huge advantage. What Randy's talking about right now, I hope you're understanding. The idea of taking that added money as that distribution from the inherited IRA for your day-to-day budget and reducing your salary and funding that 401k, that Roth 401k, this could be a game changer for you and what that future life looks like when you do enter retirement.
It really makes it unbelievable. And Aaron, did you get any money from that coffee spill?
No. We're still. I'm not allowed to talk about it yet. Actually,
it stung a little bit, though, didn't it?
Yeah, it did.
All right. So, what else can we do, Nick? What's another strategy that we've done over and over again in the office?
One of the things that we've done is we've helped clients. If you are a recipient of an inherited IRA and you are charitably inclined, one of the things that you can do is use something called a QCD, Qualified Charitable Donation. This is when you can take money directly from this inherited IRA, your hands never touch it, and you point or direct those funds directly to those organizations that you care about. So your church, church, the local nonprofit theater, et cetera. So if it's a cause that matters to you, it's a 501c3. The great idea behind this is that, one, when you take that distribution from that inherited IRA, it's non-taxable. It does not increase your income on your income tax rate, so it's not going to push you into higher future tax rates, and you're getting the benefit of blessing those organizations you care about. So I know this is newer because, Randy, this is coming through the Secure Act, and I know there's still things today that
I would
they're
say the
clarifying
majority
all
of
the
people
time.
have no idea they can do that. And how powerful that is when you think about the majority of people today, because of the tax law changes in 2017, they're not getting an itemized deduction. They're just doing standard deduction. And as a result of that, a lot of them, their charitable giving isn't even showing up. Like they're the giving, the good stewardship is there, but they get no tax benefits. So this keeps that money from showing up on their tax return. But with the same standard deduction, this is saving many times thousands of dollars in taxes.
Yeah, and the other thing this is doing, Randy, if you are already charitably inclined, what this is doing is it's allowing you to keep more of your cash in your pocket.
Yeah,
right?
Absolutely. And so, when we talk about that, if this becomes, for example, your giving, like if you have a certain percentage, like many of us do, that we give every year, and you're now giving it from this inherited IRA through a QCD that Nick's talking about, now the money that you would have been giving to charity, you no longer have that going to charity. You've got cash. And with that cash, what can you do? Well, you can fund your Roth IRA. You can fund your 401k, a little indirect version of that. You can do all kinds of things that you wouldn't. You could buy stocks or bonds or something in your brokerage account. You could also, and again, this is crazy talk, but you could reduce your debt.
Yeah.
That might be something.
Well, hey, in real talk, I mean, the debt accumulation in our country is...
Don't go down that road, Nick. Don't go down that road.
It's bad.
Yeah.
It's bad.
So, but anyway, these are really great strategies. You have to do the math on them, but honestly, powerful. Probably the QCD is one of the most powerful things that people do not know they can do. Didn't know that they were even eligible, because that is relatively new for most investors.
And no. Here's the challenge, though, Randy. They continue to change these rules. As a matter of fact, we're talking about something right now, taking a required distribution from an inherited IRA, and, for all the people that would have, where I'm going, don't you? How many times have you actually been required to take a distribution from an inherited IRA since 2019, approximately?
Yeah, me, none.
Well, for the general public, right? Zero. So it's been waived. So, and this is crazy, but the IRS has continued to waive the required minimum distribution on inherited IRAs year after year ever since the Secure Act. So we're still waiting for an actual required distribution that the IRS is going to enforce. And they've even come out already this year and said, yeah, you're good for this year. You're not going to have to take one.
This brings up how important it is to collaborate with other financial professionals, and why we're always going back to the CPA and talking to the CPA about, here's the strategy, here's what we think, we want to sign off. And these things that we talk about a lot of times, we go down in the weeds a little bit. So make sure that you're not just doing this because you heard our podcast. You want to get professional advice. Look at your personal situation and make sure you didn't miss anything, and that the rules are still in existence, because these things are changing.
Yeah. Well, and to your point, Randy, this podcast is coming out right now in 2024.
Right.
We could have somebody listening to this a few years from now, and the rules be very, very different. So please, be mindful that, it is important to collaborate with that professional advisor in your life, because they're going to know your situation, and the laws are ever changing.
Yeah. So let me talk about one of my favorite things, Nick.
Okay.
My grandkids. So another thing that you could do with that money, if you're not aware of it, is a 529 contribution. So grandparents could put money away for their grandchildren, so that they have money for college or some trade schools, the expansion under the Secure Act as to what you can use a 529 plan for is unbelievable.
Yeah, as a matter of fact, Randy, I don't know if you know this, but for primary care, I mean, even for preschool, up to $10,000 a year.
See, I did know that. You didn't know that I knew.
I wasn't sure.
All right. So, but I mean, that is a great option too. And what we started talking about was the idea that, the money's got to come out. You got to pay taxes on it. So you don't want to pay taxes twice. So the best option out of that we just discussed is somebody's charitably inclined so that you don't have to pay taxes on it twice. That is the donation through the QCD. But the other thing that you could do with a 529 plan is you're making an after-tax contribution. So the tax has already been paid. You've got the money. You put it in the 529 plan, and now a much broader list of things that you can use a 529 for. You can grow that money tax-deferred, and then if you take it out under the right rules, which, again, they could change. They have changed recently. That money can come out tax-free. And what I love about the 529 plan is, unlike old savings plans for college and university and that, the owner, which would be the person inheriting the money, is able to determine who the beneficiary is, change the beneficiary, and determine whether or not the money comes out. And if it's not used, for example, I've got 6 grandchildren. I don't know if you know that, Nick.
I've heard you like them a lot better than you like your own kids. That's what I've heard.
2 of the 3. But anyway, I do have a daughter. So one of the cool things about that is, and people don't realize how powerful this tool is. Under the current law, if I have a grandchild that doesn't go to school, gets a full scholarship, something good, something not good happens, and I've still got those proceeds, I can direct that to another grandchild, or I can leave it for them, and when they are married and have children, then I can go to my great-grandchildren or great-great-grandchildren. There's no distribution requirement. So this is almost like you're creating educational foundation by using the 529 plan.
Well, and Randy, we could really go so much deeper from the new rule that came out this year, allowing you to convert a certain amount of money from a 529 plan to a Roth IRA for that kid's benefit. Right.
And that one, just so that you know, that's pretty tricky. We get a lot of questions about that. There's some pretty firm rules around that, but it is a great option. It is limited, but it is a great option.
It is limited, but yeah. And so the thing is, we have a lot of opportunity, a lot of flexibility, and the most important thing is to know the rules, right? Like we've got to know the rules so that we can really understand what our options are.
Right.
So, Randy, is there anything else that you think would be really important for our audience to think about as, they've received this inherited retirement account in terms of what else could they do?
Well, I think being respectful of the people who have left you the funds is to be a good steward. And so that might mean different things to different people. Where is the weakness of your own financial plan? Have you done a financial plan? Do you really know that you're on track? One of the things I have people talk to me about all the time is I need a map. Like I've been working hard, I've been doing this, that, and other thing, but I don't know if am I on target for being able to send my kids to college? Am I on target to be able to retire at the right time? So it might begin, well, you've got a window of opportunity and maybe something that is causing you to rethink your plan. What is the weak link in your financial structure? So would you be better off doing QCDs, taking the cash and doing something and paying off debt, funding your 401k to a higher level? What are the things that would work personally for you that would give you the biggest bang for the buck? So really taking time with this inheritance to pause, reconsider your plan. And I've known this for years, and I've told people I could guess their income within a few $1,000s. And people have questioned me whether I could do that or not. And I said, let me look at all your bills, because most people spend everything they make. And so if you get a windfall like an inherited IRA and you don't have a plan on what to do with it, then it just goes away. It just dissipates. But if you are purposeful as to what you're doing, it could be a significant amount of increased wealth for you. And again, if it can be done in a tax-free, advantageous way, that compounding effect goes for more than one generation.
Well, and Randy, I've heard you say this for years. Real wealth lasts for more than one generation. Right. So I want to share one other option for consideration for today's audience. And, many times I'm looking at either younger families, so family members of our clients could be children, or I'm looking at a business owner, or, maybe it's a spouse where the majority of the wealth really is tied up in pensions and Social Security that eventually goes away if one of them dies. And oftentimes overlooked, and I know this, some folks are going to see this as a 4-letter word, and I understand. I can't believe I'm about to say it, but life insurance.
Yeah.
And the thing is, if you have these required distributions that are coming out, you might be underinsured. This might be a blessing to you, your family, and generations by making sure you've got adequate coverage. And I really, again, no one likes insurance till you actually need it. But the reality is, while we don't want people to be insurance rich and cash poor, we do want to make sure that we protect those people we love the most. And sometimes taking that distribution from that retirement account can help us take care of that added need.
Yeah, and there's 2 parts to that too, Nick. One is something I've done since I was in my 40s. And that is what I sometimes call, this is not the technical term, but I call it an upside down insurance policy, where I went to the insurance company and said, I want to buy the absolute least death benefit for the amount of money I'm going to put in the policy. And this is before the Roth really I was eligible for it, et cetera. And what you're doing is you're creating through the insurance companies a Roth-like feature or benefit. And this is where you're building up tremendous cash values, but you're keeping the death benefit and therefore the cost of the insurance really low. And the reason you don't see more of this is it doesn't really pay any big commissions. And if you're in the insurance business, you got to make a living, but this is dialing the cost part down to the bare minimum, still being able to treat it as an insurance policy. And I want to say one other thing. I noticed that watching a lot of the social network stuff and all that, and some of the advertisements out there, one of the things that people will be, you want to be careful about this, and I think everybody's experience is different, but funding an annuity is one of the things that's going to come up. And I don't think that's a good option at all for the majority of people, because what you're doing is if you use the funds from the inherited IRA to go to annuity, yes, you would get the tax deferral. But the 2 things you wouldn't get, which are powerful, is you would not get the step up in basis that we talked about, which we'll elaborate in other podcasts. And whenever you take the money out, it's underneath the tax code of last in, first out, or LIFO. And that means the first thing that you have to reach in to take money out, if you ever needed it, is all going to be income tax. So of all the things that we talked about, that would be the one I would stay away from. And yet that is the one that's going to be in all the dinner seminars and all the advertisements and things like that. So be careful.
Yeah. Well, and, I think you and I could be pretty candid. I mean, Randy and I, in our team, we're annuity agnostic. Okay. I mean, there's a class we used to teach called Annuities, the Good, the Bad, and the Ugly. Okay. And the reality is the right tool for the right person can make sense. But anytime you have financial gurus who are promoting one product to everybody and it solves all of the needs, right? You gotta be so careful. So again, not saying it's a good or a bad thing.
I think primarily priority.
Be careful.
If you had looked at all these other things, they probably would win in any kind of arm wrestling contest against the annuity. But the annuity will be the favored of many of the financial professionals out there. So again, you have to make your own judgment call. But I would really revisit my financial plan. Use this opportunity to do good, either do good in the world, through your charitable giving. And if you can do that and benefit your family, because it really is a double win there if you do it right.
Yeah. Very good.
Lots of really, really good things. And I love the fact that we pointed out, just because something's good, it might not be best for you. So we want them to be mindful as a listener. Is the generosity thing something that speaks to you? Do you have credit cards with a high balance or high interest rate? Like going through your opportunities and figuring out what's best for me. And then really just showing that discipline and good stewardship to really see something great happen from an awesome situation. So if you found yourself and you got that windfall, and now that inherited IRA means you have to take out every year and it's going to be taxed, we want you to consider the things talked here. If you have a thought, a question, if you wanted to know something specific to you, we'd love to hear from you. Email us at connect@yourretirementcoach.com. And in the meantime, stay coachable. We hope you enjoyed today's show, but you may have questions for our coaches, and they can be emailed at connect@yourretirementcoach.com. If you know someone that needs to hear this episode, we encourage you to share it. As a reminder, the content of this podcast is for educational and entertainment purposes only and should not be construed as advice. On behalf of our coaches, we want to thank you for listening and for being coachable.